Welcome to BizarreTrades, options for beginners. What are options? Did they confuse the hell out of you? How exactly do traders make money with options? If you answered yes to any of these questions, then this video series is for you. Pause the video as often as you deem necessary, make sure you take notes, and let's get started. So, according to Investopedia, options are financial instruments that are derivatives based on the value of underlying securities such as stocks. Confused yet? Okay, look, let's try these instead. Options are contracts that allow you to control 100 shares per contract for a limited amount of time. Does that sound better? Options are contracts that allow you to control 100 shares per contract for a limited amount of time. So, when you buy an option instead of the stock, you have the option to purchase the stock at a fixed price. This fixed price is what you often hear people refer to as the strike price, or what I often call my target price. The contract is valid until it expires. Buying options is like placing bets on what the stock price will be on a future date. For example, let's say in March 2020, Roku stocks are trading at $110 per share. You buy an option for $500 with a strike price of $110, and you choose an expiration of June 2020 for this contract. So let's say at expiration in June 2020, Roku is trading at $150 per share. As a holder of this contract option, you have the right to exercise your contract by purchasing 100 shares of Roku at $110 per share, even though the current value is $150 per share. So just imagine 100 shares of Roku for a cool $11,000, even though they're worth $15,000, and then turning around and selling them right away to make a profit of $4,000. Now keep this in mind. You have the right to buy those shares at any time before or at expiration, but you don't have to. Here's the thing. As the value of the Roku shares went up, so did the value of your options. This means that if you're not planning to exercise your contract, you can sell it and make a profit.
But wait, there's more. Hang on to your seat, baby, because this one's a screamer.
So yeah, there is a catch though. As you get closer and closer to the expiration date, the value of your option decreases. This is called time decay. So, at expiration, if the Roku shares were trading below your strike price of $110, your options will have a value of $0, thus deeming your option value worthless. We will learn a little bit more about this in other videos. So, which is the better deal? Buying the stock or buying the options? Let's compare them side by side using my personal calculator in Excel. So in the example, Roku was trading at $110 at the time of purchase. So to keep it simple, we're going to use the same exact figures in this example to do the comparison. So in this scenario, you bought an options contract and you also bought 100 shares of Roku at $110 and then sold both of them simultaneously when Roku was trading at $150. So we're going to use this first calculator here. The purchase price $110. You bought 100 shares of Roku straight up and that cost you $11,000. Then you sold it for $150 a share for a total return of $4,000 or 36% return on investment. Moving over to the right, the options calculator, you purchased one options contract of Roku. The share price was $5 a share, and remember, options are contracts and you control 100 shares of the underlying stock. And we mentioned before that the options contract in this particular example cost you $500. So you purchase an options contract for $500 when the stock was trading at $110. So that we're going to make the current price $110. Your strike price was $110 as well. And now at the time that you sold the option, the stock was trading at $150. Your return on investment in this example is $2,379 or 475%. Therefore, your return on investment, or ROI, is far greater in trading the option than trading the stock. The beauty about options is that you can make money when the stock price goes up, down, or moves sideways, depending on the option setup you purchased. In this example, you were betting that the Roku shares were going to be worth $110 or more by June. For the sake of simplicity, when you bet that a stock will go up in value, the contracts are referred to as call options. Conversely, when you bet that a stock will drop in value, the contracts are then referred to as put options. I personally use both of these types of options most often to trade alongside the market. When I'm feeling bullish about a stock, I buy calls, and when I'm feeling bearish, I buy puts. As your knowledge increases about options, you can begin to exploring other types of option setups that can give you the leverage you need to reduce risk and to further increase your chances of success. Some of these options are covered calls, covered puts, straddles, strangles, iron condors, vertical spreads, etc. To trade options, I currently bounce back and forth between 3 different mobile apps with small accounts. These are Webull, Robinhood, and Thinkorswim. Thinkorswim is one of the most, if not the most reliable app out there, but my favorite and most enjoyable app is Webull. I spend more time on Webull than any other financial app. If you sign up to Webull right now using my link, you'll receive up to 2 free stocks worth anywhere from $2.50 up to $1,400. I'll leave a link in the description below if you're interested. On the next video, I'll show you how to place option trades using the apps I mentioned, so make sure you subscribe to this channel and hit the notification bell button so you don't miss the next video. If you found this video helpful, make sure you smash the like button for the YouTube algorithm. Let me know in the comment section which is your favorite trading app. And until next time, stay safe and happy trading.